Welcome back to the Deep Dive. We're here to take a pile of, well, honestly, some pretty challenging industry sources and turn them into clear strategic intelligence that you can actually use. Today, we are tackling something that feels like an unexpected brick wall for so many specialty care providers. I'm talking about physical therapists, occupational therapists, speech therapists. You know who you are. It's the incredibly frustrating issue of closed insurance panels. If you depend on referrals, this can feel like the ground is just crumbling right under your practice. And we're going to get right to the heart of it, because what happens when those big networks just decide, nope, we have enough providers, and they shut the door? The problem is the door often looks open, but it really isn't. So many practices are built on in-network referrals, but the whole system is often propped up by what the research calls phantom directories. These are lists of providers who seem available, but in reality, they're not taking new patients, or maybe they've moved on entirely.
That is the perfect way to frame it. And our mission today, looking at the source material you've got, is to move past just, being frustrated about how unfair closed panels are. We're here to give you a focused, strategic map. We need to zero in on how therapy clinics can proactively get around these network barriers. And it's all about ensuring two critical things.
Yeah.
Getting network access where you can, and maybe even more importantly, building long-term revenue stability when you can't.
Okay, so let's unpack that. For clarity, what does it actually mean when an insurer tells a provider, sorry, our panel is closed?
Well, at its most basic level, it means the payer, so the insurance company, has looked at a specific geographic area and decided they have enough providers for a certain specialty. They've basically met their own internal quota, they've hit their limit, and they're just not enrolling anyone new. And that creates this immediate wall for any new clinic trying to get in.
And this is where that directory problem becomes more than just a headache. It's a fundamental flaw in the system. You can look up an insurer's directory, and it seems like they have tons of coverage. But the data, the actual numbers, show this shocking gap between what you see and what's real. What did the sources find on these phantom providers?
The research is it's pretty startling. One big study on network accuracy found that a staggering 58% of the providers listed in those directories were either inactive, not at that location anymore, or had closed their panels.
Wait, 58%?
58, that's massive.
It is. And that single data point really defines what we call the ghost network. So on paper, the insurer looks great. They're meeting their regulatory requirements. But in practice, when a patient actually tries to, call and make an appointment, the network is incredibly thin. It's almost empty. And this is how closed panels basically lock out competition for the providers who are already in. And that makes it nearly impossible for new practices to get the patient volume they need to survive. So if the system is built to look full when it's actually sparse, what does it really mean for the practitioners on the ground? The PTs, the OTs, the SLPs, what's the immediate impact on their practice and their patient numbers?
The first hit is just a massive shrinking of your potential patient pool. I mean, if you can't get credentialed, you lose access to almost every patient who wants to use their in-network benefits. But it doesn't stop there. It trickles right down to the patient's own experience and, well, their bank account. When a patient can't find an in-network provider who's actually available, they have to choose. They either delay care, which is terrible for their recovery, or they have to go out of network.
Which is always more expensive.
Always. And if you look at the broader healthcare picture, there's a really telling statistical contrast here. These network problems hit fields like behavioral and physical health much harder than general medicine. The data shows that about 18% of mental health patients have to use out-of-network providers.
18%, okay.
Compare that to only about 7% for general medical care. That 11-point gap, it just highlights how fragile network access really is in these specialized fields we're talking about today.
And that just puts this incredible squeeze on providers, right?
Yeah.
It forces them into these really tough business decisions. So it's not surprising that the sources point out this growing trend. About a third of private practitioners have just given up on insurance entirely.
Exactly. The administrative burden plus the risk of a panel just closing on you out of nowhere, it makes the traditional in-network model feel really unstable. So for these clinics relying on out-of-network or cash pay, it stops being a choice. It becomes a survival strategy, to stay afloat and stay in control.
But what's really interesting is the financial side of that shift. I mean, avoiding insurance sounds terrifying for a new clinic, but the data we found shows cash pay can be a pretty major revenue stream. What was that average rate the sources found?
The research points to therapists' average cash pay rates being around $143 per session.
143.
Right. And to put that number in context, that rate is about 40% higher than the average Medicaid reimbursement rate.
40%.
Ugh.
That is a huge difference.
It is. And that gap tells us something really important. It tells us that the market, the patient who is willing to pay places, are really high value on getting access to specialized care. And that's a key insight for planning your strategy.
It really is. Okay, so relying on cash pay is powerful, it's necessary, but it's not the whole picture if you want to grow.
Yeah.
So this is where we pivot. This is where we get into the solutions. Given all these barriers,
The research really boils it down to four main pillars, four strategies. And it starts with strategy A, which is credential aggressively and persistently. And this means doing way more than just filling out an application and then waiting for the rejection letter.
so it's a proactive approach.
Absolutely. First step. Before you even think about applying, you have to call the payer's contracting or credentialing department directly. Don't just look at the public directory. You need to ask them point blank, is your network currently open for my specialty in my zip code? Just doing that saves you so much wasted time.
And if they say no, if the panel is closed, that's when the persistence part kicks in. Because a no today doesn't mean no forever.
Precisely. You have to treat that denial as a temporary roadblock, not a dead end. Follow up persistently. I mean, quarterly, maybe even monthly, because payers reopen these spots all the time. A provider retires, they move, or, and this is key, the payer suddenly realizes they're not meeting their own network adequacy standard.
So that's where the leverage comes from.
That's the leverage. You need to look up your state's or CMS's network adequacy guidelines. These are legal rules that say insurers have to provide care within a certain distance, say 10 miles, or within a certain time frame. If their ghost network means they can't meet that standard, they are legally required to open the panel to fill that gap. And suddenly, knowing those rules turns your request into, well, regulatory pressure.
That completely changes the dynamic.
Yeah.
It's not just asking anymore, it's enforcing the rules.
Yeah.
Okay, let's move to strategy B, which sounds like an immediate fix for a specific patient. It's negotiate single case deals.
This is a brilliant immediate term solution. Let's say you have a patient, they want to see you, but their insurance panel is closed. You, the clinic, request a one-time single case agreement just for that patient's course of treatment. You make the case for why they need your care. Maybe you have a unique specialty or there's no other in-network provider nearby. You tie it right back to those adequacy rules.
I love that, because you're turning a one-time problem into a long-term opportunity to build a relationship.
That's it exactly. The value is twofold. One, it gets that patient the care they need right away by making you in-network just for them. But two, and this is the really strategic part, it lets you run a kind of pilot program with that insurer. They get to see your outcomes, your billing, your efficiency, all on a small, controlled scale. If you prove your value, it makes it so much easier to negotiate a full contract down the line.
Okay, next up, strategy C brings us back to those higher value options. Leverage out-of-network and cash pay. We already know it's financially viable, so the key is making it easier for the patient.
Correct. The biggest hurdle for a patient going out of network is the idea of paying a big fee up front and then having to deal with all that complicated reimbursement paperwork.
It's a nightmare.
It is. So the key strategic move here is for the clinic to become what I like to call a reimbursement concierge.
A reimbursement concierge. I love that term. So what does that look like in practice?
It means you take on that administrative weight for them. You prepare the super bill, that's the detailed receipt, and you literally help the patient understand and file their own claim. You make it easy for them to get that partial reimbursement back from their insurer. By removing that headache, you make it so much more likely they'll choose to see you. It just reinforces why building a solid system to handle that $143 revenue stream is so important while you fight the panel battle.
That makes so much sense. You're not just selling treatment, you're selling ease and expertise. All right, last one. Strategy D. Diversify payers and market reach. You can't let one closed door stop all your growth.
Exactly. And diversification here has two parts. The first one is diversifying your payers. You should be aggressively enrolling in any network that is open, even if they don't pay the most.
Like Medicare or Medicaid.
Right. Think of them as your baseline. They stabilize your patient volume while you're navigating the trickier private payer world.
And the second part is about using technology to get past the geographic limits of that closed panel.
That's it. You diversify your reach. If your license allows it, and many states have compacts now, offering telehealth is a complete game changer. Suddenly, you can reach patients in different towns, different counties, maybe even different states where the panels are wide open. It just immediately broadens your market while your local private panels are shut.
That's a great summary of the 4 big strategies. But there are 2 more angles we really have to cover, starting with what you call patient power. How can a consumer actually influence a closed insurance panel?
This is something providers should be actively encouraging their patients to do. Insurers are highly regulated, and believe me, they track everything. So if you have multiple patients calling their insurance company and specifically asking for your clinic by name, saying they can't find another suitable provider, that volume of requests, it carries real weight.
So you're basically weaponizing patient demand.
In a way, yes. The payer starts to realize they might be violating those network adequacy rules we talked about. All those patient calls act like a constant audit of their network. And a flood of calls demanding access to you can be the very thing that forces them to reopen that panel.
That is a fantastic takeaway. Use the consumer side as leverage. Okay, let's also touch on direct access. Many states have laws now letting patients see, say, a physical therapist without getting a doctor's referral first. That seems like a huge win.
It is. Direct access is great for speeding things up. It cuts out a layer of bureaucracy, and it definitely boosts your potential for self-referrals. But, and this is the really critical nuance for you, the listener, to understand, while direct access makes it easier to start therapy, a patient can just walk in your door. It does not override network rules.
So it solves the access problem, but not the coverage problem.
Precisely. If that patient's insurance won't cover you because the panel is closed, they still have to pay out of pocket. Direct access just opens the door, whether it leads to an insurance payment or a cash payment. It doesn't solve that core financial hurdle.
That's a crucial distinction. Wow. We've covered a ton of ground here, from the ghost network problem all the way to real, actionable solutions. So to just quickly wrap the core takeaways from this deep dive, navigating closed panels really demands proactive checking of panel status, strategic negotiation with those single-case deals to get a foot in the door, smart leveraging of your OA and cash pay options by offering that concierge-level help, and finally, relentless diversification, both in payers and in your geographic reach through tech like telehealth.
Absolutely. And, we've established that patient volume is critical, but we've also seen that cash pay rates are significant and sustainable, averaging that 143 a session. So if we just connect this to the bigger picture for a second, the fact that insurers use these ghost networks so widely, it really forces a reevaluation of how practices should operate. The really interesting dynamic to think about is this. Should therapy practices keep trying to rely on this traditional super restrictive in-network model? Or should they maybe start designing their core services specifically around the high-value cash pay option that the market is so clearly telling us it supports? The fact that insurers are forcing the issue might mean the answer's already here.